Okay, welcome back, everybody. It's nice to see a few of you back after having a little bit smaller of a group last week. But I just wanted to mention something really quickly. I started reading a new book lately. It's called The Psychology of Money by Morgan Housel. And I just thought there was a line in here that was really interesting. That's kind of going to go into what we're going to start talking about, because we're going to start talking about actually investing now. We're going to really start diving into what it means to be in the stock market, how to participate, and what that is like. So the thing that I wanted to call out from this is the person who grew up in poverty thinks about risk and reward in the ways the child of a wealthy banker cannot fathom if he tried. And really, the thing, sure, no problem. Okay, so back to, yeah. Oh my gosh, there it is. The person who grew up in poverty thinks about risk and reward in ways the child of a wealthy banker cannot fathom if he tried. And I just think that is important for us to take with us as we get into this conversation. Um, a lot of people will look at the stock market risk and just try and look at it objectively and try and see how you should participate objectively in terms of just the numbers, and like you should be getting a certain amount of return, or like you should be buying all of the S&P 500. But I think it's really important for us to look at what our biases and what our emotions are and what our experiences are with risk in the market and outside, so that we know that when we're making decisions, we're actually making a decision that is working along with those qualities about us emotionally. Because what you'll find sometimes is that, you know, the statistic about people doing better with a financial advisor, about earning 3% more a year or whatnot, is not really due to a better investment philosophy or a better investment strategy. It really is just keeping them going through the tough times in the market, uh, riding out those falls and making it through to the recoveries. Now, the other thing that you can do if you don't have an advisor is to make sure that you play towards your own personal beliefs and biases, because that's what that advisor is likely going to do when they're having a conversation with you. If the market goes down by 20% today, and then I have a client come in and panic, I'm going to speak not just about why I think the market is going to recover and all of these things. Like, yeah, that might be important information, but I want to make sure that I'm having a really good emotional conversation with this person, so that I know that I'm keeping them on board with the plan that we put together and why the pieces of their plan support that. So if there's different types of investments that make them feel more comfortable about sticking with them through the long term, and they still accomplish our goal, then there might be a little bit of a tilt over there to make sure that somebody stays participated rather than panic sells and gets out. So I thought that was an interesting comment about risk, where it's not specifically about investing, but it's just kind of like understanding what is your perception of risk and how can we make sure that we filter what we're doing in order to support that and not put you in a situation where your thought is going to take you outside of your plan. Question back here.
Yes, I have a question from Zoom. I'm going to read it. It says, I'm starting to see predictions of a market crash again, even though the S&P 500 is doing very well. Can you please provide any comments on that?
Well, I think, yeah, I think economists have probably predicted a good 5,000 out of the last three crashes so far. And it just, we're never going to see it coming. That's just really not how it works for the most part. Like, if there are things that are fundamentally wrong, like in 2008, things were fundamentally wrong, and there were people that could see what was coming. But I would just be curious to know on what exact basis is this crash going to come from? When is it going to happen? Because if we know and we're able to predict it, please let me know so that I can make my returns a whole lot better. Yes.
Shutdown seems to be troubling people, the potential
Okay.
shutdown, and that is imminent.
Sure. So what would be our big risk from that?
I could everything blow up.
Hmm.
We lose everything.
What?
Most of everything.
Well, why? This is just kind of like where we start getting into conversations where, like, I want to know, well, what is the risk? What are we actually worried about? Because if we can't quantify it, if we can't actually put it to words, it's impossible for me to look into the probabilities of something happening or not happening. Yes, government shutdowns could happen, but they have happened many times in the past. And I don't know if from experience you have anything to comment for that?
They already know that if the government shuts down, the essential workers will pay, one party will blame the other, even if the market drops for a while. In the long term, it's not what's going on in politics, it's what the economy looks like and what's being built up for the economy. Right now, there's a lot of anticipation, a lot of money coming to the US to build up the US economy. One could argue that's a sugar high, we're spending too much money and it'll crash in 10 years or 5 years. But right now, the government closing is just going to be a big win for one party or the other. And it's going to scare a lot of people. It's unfair to do that to investors. But the only thing I would be doing, if we will do, is hold a little bit of powder on the side. If anything does cause us psychologically to get scared, the market falls, that's when we reallocate towards the risk and not away from it.
Yeah, and so I would say that one of the main things is whenever you are in one of these scenarios where people are beginning to predict some sort of outcome, take that outcome as if it's going to happen and bake it into your plan right now. And then tell me if you're ready to sustain that, if you're ready to sit through it. Because if the answer is no, if that outcome happens and you were fully invested the way you are right now and your dollars dropped by however much percent that would be, are you going to stick it through? Then you should be fine. And we can speculate about the reasons why or why not a crash may happen, but it ultimately will not matter. But if the answer is no, and you're not going to be able to fulfill your goals, or you're going to have a change of heart, or you're going to do something that's going to change the course of your plan, then it's time to reevaluate. So, just speculating on what's going to happen is just not really part of, I think, what makes a strong plan, because it brings you down to this granular level where if your foundation is not set up anyway, it's just not really going to help you. That's just my opinion.
Something that we think is coming. It's a forward indicator, so it'll already start to decline. It's the things you can't see coming that hit you all at once. And then as people panic and the market falls, the computers, the algorithms, the investors jump on and they get out too, but they're not getting out because they're afraid. They're getting out to wait for everybody else to get more afraid so they get back in. So as Nash says, if it's long-term money, add more. If it's short-term money, should be there in the first place.
Yeah, and there will be, as we go through, there will be quite a few slides and here quite a few data points that I'll reference that'll sort of talk about this conversation as we dig in there. But let's get our disclosure slides out of the way. Obviously, we're recording things for you to watch this later in case you miss classes. And this week's Friday Forum will be at 3 p.m. The Journey of Sacramento Philharmonic and Opera, and Orchestra and Opera for the 21st Century. And it looks like they actually put the hall in there this time, so you know where to go. Mendocino Hall 1005. Really great that they actually put that in there this time, and I didn't have to just kind of panic at the last minute. Yeah, oh, wonderful. Thanks. See, that's why they value us so much. And then they also wanted us to talk about, in case you wanted to start, run your own program, they do all sorts of things from our big, long 12-week classes to shorter workshops, as well as even one-day things. So if you have something that you want to teach, it doesn't have to be, obviously as granular as financial planning. I'm sure you've seen a lot of the other wonderful things that are out there, but please do. You've got your start dates and end dates down here and different things. So anyway, on to our conversation. Let's recap what we talked about last time a little bit. For those of you that weren't here, maybe this will be, some of the things you missed, and then we'll just kind of go over what we talked about. So we went over some pretty basic things. So we talked about different types of accounts, how they exist. So how I sort of break things into your tax advantaged accounts and your non-tax advantaged accounts. So this is pretty easy to sort of categorize these. You've got your tax deferred accounts like traditional IRAs and traditional qualified plans where you get the tax benefit going in and then you pay taxes on the way out. You've got your tax exempt plans like Roth IRAs and Roth qualified plans and 529 plans where you put taxable dollars in and then you get tax-free withdrawals on the way out. 529 plans being limited to qualified expenses, of course. And then you've got all your other non-tax advantaged accounts where the contributions are made with after-tax dollars. And if there's earnings, they get taxed in that year. That'll be your individual, joint, trust, estate, custodial, business accounts, and all that sort of stuff. Any questions on like account types or where one might fit? No? Okay. Then you've got plan types. So this is when we start getting into sort of like the employer retirement plan space. You've got your qualified plans and non-qualified plans. If a plan is qualified, it means it's qualifying under Section 401A, which is where the term 401k comes from. It's a plan that it's like the main plan that complies under Section 401A, also 403B, 457, it's all in the 400s. That's how you know it's one of these plans. So you've got your traditional and Roth 401ks, traditional and Roth 403Bs, SEP and simple IRAs, traditional and Roth 457Bs, Keogh plans, employee stock ownership plans. And just so you know, an IRA is not a qualified plan. You'll hear the term qualified account. We use the term qualified account because we like to think that it qualifies to not give me a whole bunch of tax consequences if I buy and sell inside of it this year. So if you hear somebody talking about my IRA being a qualified account, it's really just because it qualified for a tax deduction going in, and it's not going to generate taxes as I trade inside of it. But that doesn't make it a qualified plan. Now, the difference is the qualified plans get a whole bunch of protection from the Employee Retirement Income Security Act, which means that the entire balance of the account has been segmented for your retirement and cannot be touched by a settlement or a lawsuit or anything like that. Totally protected. IRAs get about $1.5 million across the aggregate of all the accounts. So if you've got a traditional IRA and you've got a 401k, if you want to have your 401k be in an IRA, do we want to roll it over into that traditional IRA? Is that probably what we would want to do? No. We want to roll it over into its individual IRA account because in California, it's called a rollover IRA, specifically because it received a rollover from a qualified plan. Now in California, I don't remember what the exact name of the court case was, but they determined that if you roll over a qualified plan into an IRA that is not commingled with traditional IRAs or anything else, it will receive the same level of protection as a qualified plan, as if it were still in the plan, so that you can roll it out and have more control over that asset and still retain the same protection. Now, the California state will be the one providing that, not the federal government in that case. Then you've got your non-qualified plans. So that's just retirement plans that don't qualify under that, so they don't have the same protection. So it's things like deferred compensation plans, split dollar life insurance, you pay a little, they pay a little, executive bonus plans, and sort of the other stuff on the outside. Yes.
Yes. So you're saying retirement qualified versus qualified. And okay, SEP and simple IRAs, I'm just sort of confused. I thought that they did qualify for a risk SEP, do they?
Yeah, so they actually do, right? That's what I was looking at.
It should.
Yeah.
Okay.
Yeah.
Yeah, they do. They do actually qualify because they're a certain kind. It's kind of like it's kind of like creating a less complicated 401k and not going through all of the formal steps and just like kind of quickly creating something so that you can have a retirement plan.
Self-employed pension fund. It's more like an individual profit sharing plan, similar to the form.
Yeah.
Thank you.
And so then you've got your popular investment vehicles, which I'm sure most of you are familiar with. We went through these sort of basics. You've got your stocks and your bonds, mutual funds, exchange traded funds, and the differences between those. With the exchange traded fund, you can buy and sell just like a stock. So like with a stock, you can buy and sell it during the day. You can do the same thing with an ETF versus a mutual fund. If you're familiar with it, you have to wait until the end of the day for them to calculate the value of the fund, and then they will sell it to you at the net asset value of what's held in there. You've got non-publicly traded real investments, so stuff that's not available on stock exchanges or through standard brokerage accounts. Not really a popular investment vehicle, but they are becoming more popular because they're starting to be wrapped up in ETFs, which is really interesting. Things like private credit and other alternatives are being offered in these new ETFs. You've got your fixed and your indexed annuities, which are those insurance contracts that are, annuity that wants to pay out a lifetime income at some point when you decide to annuitize it. And the index annuity basically is very similar to a fixed annuity that just says you get this amount of interest, versus the index annuity says we'll give you a certain amount of interest based on the performance of some index like the S&P 500. It sounds really nice, but oftentimes there are participation caps, like they don't let you participate fully in the gain, obviously, or else they'd have no money to take home, or they just cap it at a certain level. So you might have an indexed annuity where you participate in 80% of the performance. So if the S&P went up by 10%, they would say, we'll credit you 80 or we'll credit you 8. We actually also put a cap of 5 on top of that, so you only get up to 5. So if you're looking at something like an indexed annuity, just make sure you understand what is the real expected performance that you could be getting out of something like that. Then we talked about fund strategies and just kind of like what a fund could be doing. We talked about index funds, which are some of the best low-cost ways to just get exposure in the market. We talked about passively managed funds that maybe they have a little bit of a strategy that they do, but they don't do it out of their bright ideas that they have while they're in the shower. They have an actual quantitative process that gets them there, and usually some sort of computer program or some sort of just set in stone process that you've put in a list of stocks, and then it will generate what they're going to put in there. So oftentimes they will use qualitative and quantitative factors. So if you hear about a factor fund, usually that's what this is referring to, is some sort of passively managed fund that's saying this factor, this certain thing about stocks, I want it to be at this valuation or this valuation in order to include it in my fund. Then you've got actively managed, where the fund managers actively try and choose the securities that they think are going to do best based on market conditions and try to just do whatever they can that aligns with the fund's objective. And then a target date fund, which is something that if you've ever had a 401k, these are one of the most widely used and easiest to use investment vehicles, period, because it just puts a date out in the future and says, we're going to be our highest level of risk now, and then we will move slowly over to our lowest level of risk then. I kind of like target date funds when we're looking at people who just need to focus on their careers and accumulating assets, because it just kind of allows you to get all of that diversification baked into one single product, and they'll adjust the risk for you going on. Now we can later maybe have some discussions about why I don't particularly like target date funds after the accumulation phase, because of our inability to manage what's inside them. Yes.
Just to be clear on the set, it is protected if it's an employer-sponsored plan. If you just as an individual do a set, it may not for those sort of stuff.
Okay, interesting.
Yeah, clarity there.
Yeah.
All right. Then we compared our mutual funds and ETFs. Mutual funds, you're generally bought and sold on what's called the primary market, which is essentially between you and the person who's creating the product. Now, a brokerage firm might be in between and be the agent for that transaction, but generally, like what's happening is you are paying the fair value of whatever's in the mutual fund divided by the amount of available shares, and then you're buying that many shares. Versus in the ETF, it's more like, I bought a share of it for $10, and now maybe everybody's really excited about it. And so I go, well, I don't want to sell it back to you for $10. I want you to pay me $15. And so we would be trading it back and forth, and that would give you access to the investments inside that. So it's a similar vehicle. It's just kind of, the differences are less and less as time goes on. And most of it is just to do with who you're buying it from, whether they're forced to pay out capital gains distributions or not, and whether they trade throughout the day. So with the mutual funds, there's no, like, you can't buy it in the morning, sell it in the afternoon. You can only buy and sell once per day, because at the end of the day, they calculate the value of their holdings. And so the thing with the mutual funds, the one good thing about it being sold in the primary market directly to the consumer is that you don't have this problem of there's not enough people buying and selling them in the market. The spread between the person who would buy it versus the person who wants to sell it is too wide. None of that really exists with mutual fund. You just go, I want $5,000 of this fund. And they go, here's $5,000 of this fund at the valuation that we determined today. Versus with an ETF, if there's like 3 people who have all the shares for the ETF and like 5 other people want to buy some, but they all want to sell it for $250, but nobody wants to pay more than $97 for it, there's this whole wide range. And like you have to get somebody to agree to a sale. It becomes more like an actual, free market in that sort of scenario. So you have a possibility of just like, you might have to pay premiums or you might get a discount if there's not a lot of people transacting. This is the same sort of thing for stocks. We talked about market indices a little bit. We talked about the Standard & Poor's, Dow Jones, and the NASDAQ as being sort of our major 3. And then we talked about a couple other ones, but we won't worry about those right now. Today, what we're going to get into is some of the foundational information and knowledge and sort of theories about how we actually build a portfolio and what is the philosophy that we're going into this with. So I like to call it new portfolio construction theory because I like to make it sound like it's my idea. But basically, this is just concepts derived from modern portfolio theory, which we'll talk about in a second, and our experiences working with our clients. So part of this is not going to be just based on numbers. Part of this will be from the psychology point of view, from the actual success with the client point of view, and really just how have we begun to build portfolios that actually work with our client base so that that works together, because a portfolio can be successful on its own, but it's our job for the portfolio to be successful with the client. That's much more important. So it's the basis for how we select investments, and really it's a guideline to simplify portfolio building. Making an investment portfolio can be pretty much as simple or as complicated as you want it to be. You really have full control over it. But here we'll try and show you a way to make it intentional about what you're putting in there. And you can make it as simple or as complicated as you want. If you want to use 1 fund, have at it, just know why. If you want to use 3 funds, good for you, but understand why and what they're doing. If you want to use 30 different funds, or you want to use 300 individual stocks, good for you, but understand why. So the number one thing, yes,
Modern portfolio theory.
yes.
Is that your firm's?
No,
That's a
modern portfolio theory is a general thing, yes. We will speak about that in just a moment. So the most important thing that we have to think about when we're choosing investments is we have to understand the length of time that we have. How long do we have between now and when we need to spend the dollar that we're investing? Because the longer time we have, the more risk we can take. We'll talk about why that is in a second. The stronger our liquidity needs are, so the stronger our possible need for needing to move assets out of the portfolio at any given time, the less risk we can take. Because if we have a whole bunch of time, like this account should last me the next 20 years, but I'm going to take out 60% of it in the next 6 months, okay, I'm not making investments for 20 years. I'm making most of my investments for 6 months. So creating a portfolio is really just a game of balance between these 2 things. So there's 2 things that we use, 2 sort of processes that we came up with for how we build portfolios. One is called lateral integration. And it's called lateral integration because it's how we use time horizons and risk tolerance to choose portfolios. You can kind of think of it as like a nice big long timeline, like for where each event is, each spend or each contribution, like how are we creating a timeline for the risk? So the further out we move, the further up the risk goes. We'll dig into that in a minute. Vertical integration is pretty much how we take care of diversifying against risks and then positioning ourselves in the sectors of the economy that we would like to be in. For the most part, we like super cheap index funds because I'm not trying to pick the next stock. I just want to participate in the market movements. But you might have values or strong convictions or any other multitude of things that are going to influence your portfolio building, where as we move up, that can become part of the process. So let's talk a little bit about a volatility example. We're just dumbing this way down just to get the point across. So you've got an upcoming house purchase. Let's assume upcoming means like within a month or two. Investment A has a 95% chance of returning you back 3% and a 5% chance of returning you back 1%, versus investment B, 50-50 could go either way. It could either double or half it. Which one are you going to pick for this scenario?
Doesn't it depend?
Well, what does it depend on?
Oh, it's in the next month.
So any ideas? Because I'm picking investment A. Because if I only have a little bit of time to go and I have a certain expense that's coming up in a short period of time, I'm not going to take this chance. It's possible that if the timeline was 5 years, this would be slightly more biased towards the positive return, right? But it's not, because we're in that short time frame. This, if we were looking at this, it's likely that this would be something like a really small individual stock, or this would be something like a high yield savings account, where you could see they might be bringing rates down. You know, it's just kind of looking at what do those different assets look like and what are we using them for. So the law of large numbers is the main sort of concept between market average returns, or when you hear the S&P does 12% or Dow Jones does 8%, or any of these indexes, if you hear that a certain group of stocks does this amount per year, they're not saying that every single year, back to back, it's going to have the same return. So you can't expect that. You can't go, all right, in a year I'm going to buy a house, so I'm going to put this in the S&P 500 and I'll have 12% more. You might have 30% less, you might have 60% more. We don't know. But I'll just read you sort of like the definition, and then we'll get into what this means. So as the sample size grows, its mean gets closer and closer to the average of the whole population. So what that's saying is, if I have, let's say, a big population of people and we're measuring their height, and let's say on average they are 5 feet tall, you're going to have a bunch of people in there that are 6 feet tall, 5.5 feet tall. You might have some 4.5 feet tall or some 3 feet tall people. And if you just grabbed 3 of them at random, you might pick 3 3-foot tall people and go, well, this doesn't make any sense. That's not what the average said. And then you might grab another 3 people. Be 3.5-foot tall people or 4-foot tall people, but you're still not hitting that average of 5. And then you go and you grab more and you go, wow, there's a lot of people that are 6 feet tall. And that guy's 8 feet tall. And then the more people that you get, when you average all their heights together, it actually represents what that measured average is. So it just shows that you can't basically rely on small bits of data to represent, you know, the whole or the average picture. So the reason that I like to use this as an explanation is because insurance companies use this all the time. This is exactly how insurance works, period. If I'm insuring a risk, I want to be able to insure a risk that I can insure a bunch of times over so that I understand what the probabilities are. But if I only insure a very small subset of people who are exposed to that risk, my risk actually goes up by a lot, because either nobody could get that risk and I never have to pay out a policy, or every single one of them now goes through this and I have to pay out on every single policy and I'm completely bankrupt. So the more people with the same risk that I can insure at the same time, the better I can sort of strategize what my premiums that I charge are, how much do I actually pay out. And so it's that same concept for insurance and for investing. So here's just like sort of an idea. This is Dow Jones from 1974 to 2024. And looking at these charts, it makes it really easy to go, wow, investing in the stock market is wonderful. And, you know, this would be that nice average, like 8, 7, 8, 9% return compounding all the time. Of course, you've got your big dips, great financial crisis, all sorts of different things. But in reality, this is not what being invested day to day, year to year looks like. This is what it looks like at today, backwards. This is not what it looks like to be here, here, or here, here. That looks more like this. Each of these are years of returns. Now you can see that there are plenty of years that have nice big red bars that drop down. This little bit in the section in the middle is negative 20%. This is 20%. The top is 40%, and the bottom is negative 40%. So you can see that even though we had an average really strong growth cycle the whole way through, you're going to have these periods where it feels like nothing's going right. And you're going to have these periods where it seems like 8%, that's not what I'm getting. I'm doing fantastic. So you have to understand that this is the type of variability that you have to expect in order to achieve that. So we can kind of just see this here. So the Dow Jones index had an average return of 8.7% from 1998 to 2022. And that was measured by an ETF that tracks it that was made by SPDR, DIA. And you can see here is a couple different returns, 2012 to 2021. You can see that, you know, remember 8.7%. I see that nowhere here except for maybe twice, gets pretty close. 8.98% in 2020 and 9.28% in 2014. Otherwise, it's either double, quadruple, or we went down by like 12% in comparison, right? So each year is incredibly different. So again, that's why even with, you know, worries about big crashes, big declines, we have to understand that all of this is, each one of those years is just part of what builds this overall experience of growth, because things have to happen in cycles. Here's another interesting little chart that I really like. It's from Morningstar, one of our favorite places to gather data, and it shows 4 categories of investments. You've got small stocks, so stocks that have a relatively small size. You know, it doesn't really sound like a small company, but I think it's like it was like 200 million or something like that market cap. Do you remember what the market cap for small cap is? Okay, yeah, but small cap is like 200 million or something like that. Anyway, small companies, and then you've got your large stocks, which are much bigger than that. Your standard like blue chip stocks or S&P stocks, long-term government bonds, so probably 20 to 30 years is what we're thinking about. And then you've got treasury bills, which are your nice little cash and cash equivalents from the government. So what this shows is sort of if we look back between 1926 to 2022, what are the widest fluctuations for each time period? It's a little confusing. So basically we're using 1926 to 2022 as our time frame that we're looking at. And we're looking at 1-year periods, 5-year periods, and 20-year periods. And so what this is showing is what is the greatest fluctuation that you could have in either direction from any of those time periods during all of this. So if you held small stocks for one single year out of any of those years, it could have gone by 150%, or it could have declined by 60. But if you had held it for 5 years, any of the 5-year periods, it would have gone up by about 40% and could have declined by almost 30. And then you get to a 20-year segment, you held it for one of the 20-year periods, and then that squeezes down even further. So this is just showing again and again that as the more time that you are to participate, the risk profile actually goes down. So day to day, you still have the same fluctuations, but in reference to what you originally invested, your risk profile squeezes. And so you can see same sort of things with large stocks, just not quite as much. And then your government bonds, and then your treasury bills here. Any questions on any of just sort of this underlying information? Yeah. So what do we do to use this for our advantage? Well, we hold riskier assets for longer periods of time, right? Pretty easy conclusion based on this. If we want to hold a really risky asset like a small stock, we should probably hold it for a really long time, probably not for a 1-year goal, likely not for a 5-year goal, but probably for a 10, 15, 20-year goal. And maybe treasury bills, I'm fine using it for a 1-year goal because we don't have that downside. But again, it's just all of these different things, understanding what is the range that we can have. Use less risky assets for immediate needs, just mention that. And then diversifying across asset types. Remember that you could have a year that was the positive year for the small stocks, but it could have been the negative year for the long bonds. All of these things may perform in slightly different ways. So being diversified across the different asset types also gives us the opportunity to where, well, if you'll remember, they don't mention international stocks on here, but I've been kind of like putting a little bit of international exposure in some of our portfolios. And then we just happen to have this first quarter of the year where the US stock market really was feeling some stress based on all the tariffs, but international companies, they weren't so worried about it. I think they're up by like 26, 28% year to date right now. And it was something that went just in the complete opposite direction while the US assets were really having a tough time. So it was something that, while that was doing really well, this was doing really bad, it actually kind of flattened the effect of that downturn in the US market by having those returns that simply went the other way at a different time. And then dollar cost averaging is also a great thing to throw in there. It's mostly for people that are accumulating, but also at the same time, let's say you parked a bunch of cash and you're a little bit worried about getting back into the market. Dollar cost averaging is fantastic because with dollar cost averaging, the idea is that the system could keep the average cost of shares low. Your purchasing power has the potential to be more efficient without the need for tracking share price, because what you do, I'm sure most of you are familiar with this, is you just say, I'm going to invest this much money at a regular interval and just buy however much it affords every single time, back to back to back. I'm not buying 100 shares, I'm buying $1,000, and you're just buying the same dollar amount over and over again. What this does is it makes you buy more cheap shares and less expensive shares. And then if the market in general will have a upwards growth over the long term, then that's beneficial because we're buying more cheap shares and we're buying less expensive shares. Now, honestly, when it comes to long-term investing, the math shakes out the best when you just invest it all day one and then look away. That's when the best numbers come out. But this gets a really good periodic thing that you can do that does actually have some numerical benefit to where you could slowly get back into the market. Or say if you just have a whole portfolio of bonds, you could take the income from those bonds, buy a little bit of stocks, and you're not taking risk with the principal value of your portfolio, but you are actually giving yourself a little bit of growth potential. So you can see in both a bear and bull market, the idea, because you're buying so many fewer of the expensive shares and so many more of the inexpensive shares, that your average price gets dropped, gets pushed below, which is pretty nice. So here's basically a risk tolerance spectrum of the different things that you can invest in from Morningstar. And then after we finish this, we'll take our break. Morningstar has determined that small stocks are the riskiest thing that you can invest in, but they also have the highest potential return. International stocks are the second riskiest thing that you could invest in. However, they also have the second highest potential return. Now, I would be curious over what time frame this is, because if we're looking at this for recency bias, those top two picks, international stocks did really well recently, but small stocks have been not really doing much of anything recently. They've been really just kind of trading sideways. And then large stocks are kind of in the middle, but as of right now, those giant tech stocks like the mega cap, the super giant companies, they fly up and down in value, and they've been performing better than anybody else. So that's another reminder of it really depends on what time frame we look at. But I'm assuming this is on the most data that they possibly have. Then you've got your corporate bonds, and then government bonds, and then cash alternatives. So it's really just kind of ranking things on low potential return to high potential risk. So when we come back from our break, we'll start talking about sort of how we can get a little bit deeper into what our process is of how we can actually start using time to help with our asset allocation. But before that, I'll just leave you with, so these aren't necessarily what you're going to pick in your portfolio. But if you think of like what the status quo is of when I say short-term assets, intermediate-term assets, and long-term assets, it's pretty much short-term is cash, intermediate-term is bonds, and long-term is stocks. If you're familiar with a group like the Bogleheads, who follow the founder of Vanguard, and they love cheap index funds, and they don't want to pay fund managers to do anything. They usually don't want to work with financial advisors, and they just want to do everything in the simple way. Be oftentimes just a T-bill security, a bond aggregate fund, and a total global stock fund, and then they're done. And that is a way to build a portfolio. But we'll look through sort of our methods and why I may make some slightly different choices than that. But for now, let's take a 5-minute break, and then we'll get deeper into it when we come back.
No, that's John Bulwer.
B. Oh, just like the wine.
Yeah, John. Okay, yeah.
Okay.
But John Bogle, who used to run Vanguard,
Oh.
he's like a Warren Buffett. So they have little groups. Hi.
I was just at.
Oh, you did?
Yeah.
Well,
He spent, well, I said, I just really want you to give me something for him. And there's some, and then he just spent a long time on it himself. Was
Yeah.
the other thing, why it would be good for him.
I feel for him because he's not in the company. And so
Yeah.
we in the future are gonna try to recruit people like that. Because for their career, it's better for them to hold accountability and responsibility for what they're doing. And say, well, I did this or talk to you on that man the company. But unfortunately, a lot of what he does, I assume, he's really stuff that is dictated by the company. So he has to sell himself for.
Yeah, I didn't bring this up, but also the way you talked, it was like that was not. So, it was just, I don't know, I don't have enough knowledge, like, to get some inside working on it.
They have the home office, they have PhDs and super smart people doing their portfolio. But is that portfolio purchasing power, but you're only a little bit how to understand risk and help.
You said something about charging, and I'm like, 2%.
That's a lot.
That seems like a lot.
Yeah, the industry average 1.2 for, let's say, less than 500,000.
Yeah, it just, so,
Well, yeah, and it's not all, whatever the fee is, it's not all about the portfolio management. That's one of 10 different things that are involved. We've got 5 facilities. He's one of them. We have back here. We have several team members that want to get the money out, there's a registration. the whole administration process. We wrote that in the back of this book. And so there's somebody who's doing all of that, and you just love it when you call them and you just call that, and you get everything handled. That's what the fees for, not just managing money, because you can call Vanguard and say, look, I got so much money, here's my, whatever. Okay, we'll put you in buy Vanguard fund, fair enough. And that's not bad, but it's the overall estate planning, financial planning, tax planning, everything involved. That's why the client needs to meet with the advisor, and then the advisor gets kind of a bubble around that client works with it. We have beginning model portfolios, but then they're customized based on the client's needs.
Yeah, because you know what I find interesting, like I've always invested in real estate, you know, I was making. So, but you know, then a couple of others have used, they don't have any say in that, whether it's in their opinion, whether it's a good thing or like, well, I want, you know, that's all of the thing. It's real estate, why don't you have any comment or opinion on, should I buy another house, isn't it, that's just like, oh, no, it's whatsoever. They want to go, I mean, and I'm like, well, that's not the full picture.
Right. Their companies need to get as much money under management, making the fees, like if if they don't care about what else I do, how are they going to tie it together? I have clients that have a legacy stuff that's gone way up. They sell too much in stock. So the Nash works around that with other things to balance out that high risk of one stock. It's a lot of legal estate. I have 5, 6 properties, a couple on Main Street. Yes. And one, I don't really love the restaurant building, but I appreciate it all the way down. And something really low if I sell it, and the cap rates aren't all that great, but downtown's gonna grow to do that. So I'm in the same place, but you're probably better in some residential properties. But they should be there to that, and if they're not, then it's like a doctor operating like one.
Like it just did a, you know, you just did a whole thing and made a projection, which was kind of depressing.
Yeah.
So basically, here's the amount of money at 95%.
Well, but including the real estate.
Well, exactly, it's like the whole assessment we did was based upon me living in that home, which is in high rent district, so to speak, you know. It's like, I would be doing that, you know, in 5 to 10 years, I'm not gonna be living there. It's not gonna be that big old house. But none of that was inclusive, it was just, it was just a scenario as to, well, this is what you'd be paying when you're, you know, 85, well, I'm not, and I've got equity, therefore, why can't we take it and make projections? I wanted to help us out there to listen to everything you have to say, and, you know, give them my input about my risk factors and stuff, yeah.
It's unfortunate because it's almost irresponsible not to know this, because one house has like 5 different options, right?
Mhm.
Sell it, tax, if you have it, or you can move out, turn it into a rental. So within 2 of the last 5 years, or lose the exclusion, but then they start depreciating, or you can do a million.
Yeah, there's a lot of variables there, right?
Yeah, I'm
To-
building my house out as a long-term care facility. My company.
That's a good, I've heard that's a very good investment.
Yeah, well, I have a lady that lives there for free. She just does chores. I'm on 2 acres of choice around the house. I'm on the Albert, so I bought it 3 or 4 years ago, white water, all this stuff, cleaned it up, it's just a little house, breaking it into 3 little pieces. But that other place you saw on Main Street, that's the house behind me, so I need to remodel that. There's a lot of things that people don't think about. Young people, I can't afford a house, look at you, but buy some cement. Buy something that's got a well on it, then do whatever's allowed, subsidy wise. Put a metal tiny house, so you have to buy insurance on that. And then you can start building the house over this third, a little longer drive. So, yeah, the people, this other advisor, like I mentioned before, home office tells them, and it's not around your streets. I have clients that we.
Well, it is, you only from a.
Yeah, but
from that,
not your.
it's you, not the whole thing, and it's most of my money is into, real estate.
And even the most important thing, if you've got more than one property, is the liability in properties. You have 600,000 of possible liability in homesteading, right? And if it's worth more, you've got insurance. All the little insurance, we don't sell insurance, but you have to cover that. Yeah. We don't do the tax, so we have to cover that. We don't do a fee.
Yeah.
You have to cover, I mean, before it's in life, it's like a doctor saying I'm a general doctor. You're not gonna look at it. The really good doctors can walk in and see, I don't know.
All right, let's try. So you just turn on like this.
And then you're.
All right, let's get back to it. And just a little thing that we're gonna start doing. So we have some people that are on Zoom and sometimes they can't, hear questions too well. So if you have a question, throw your hand up. Grigor in the back will run over to you with a microphone and then we'll do it that way. And if you don't want your unadulterated voice to be on our video recordings, just let us know and we will do our best to make that more private for you. So we were just talking about sort of time-based asset allocations with cash, bonds, and stocks, sort of the sort of normal things that you think of when you think of putting a investment portfolio together is basically these three things. But then there's another thing that we want to do is we want to make sure that we diversify. So I could have a non-diversified portfolio of a little bit of cash, a single government bond, and then NVIDIA stock. Technically, each of my buckets are filled, but I don't know how diversified that is, and I might be susceptible to a lot of risks. So diversification is the process of minimizing exposure to any single risk by combining multiple assets of different types and exposure in a portfolio. The reason you'll hear about diversification, or I'll talk about diversification when we talk about investing, is not in the frame of mindset of how to make as much as we can, but it's how to reliably and steadily get an average return without having the possibility of one company specific event really dragging down our probability of success with whatever it is that we're trying to do. So here's a chart on stock diversification. It shows you two types of risk. One's in yellow, and that's company risk. Company risk is any sort of risk that is only applicable to that company. So if, say, for example, any company could have a CEO that decides to just go ahead and make a whole bunch of terrible decisions. That's not really going to affect anybody else in the stock index except for that company. They may just simply fail to deliver a good product to their customers, and then their share price tumbles or whatever, and the company goes under and whatever kind of stuff. They have too much debt and it collapses them. That's not going to be something that drives the performance of all of the other stocks in the stock market. So the more stocks you have in your portfolio, the more you start to reduce that company specific risk. Because if I have Apple, okay, I'm completely exposed to Apple's risk. But then I go and buy some Coca-Cola, totally different industry, totally different product. Okay, it's likely that things that affect Apple probably are not going to be the exact same things that affect Coca-Cola. And then I add Ford, and then I add NVIDIA or whatever, and I just keep moving it forward and keep adding more and more stocks. So you go from one stock to two stocks to 4, 6, 8, 16, 30, 50, and then this wonderful area with 1,000 where that company risk is like almost not even there. It's pretty much diversified away. However, you'll notice the thing that did not change is market risk. And so market risk is the type of risk that exists simply by participating in the market of stocks and shares and companies. There is some risk that's just inherently associated with that we have to take on. That's what gives us our opportunity for return. But there's a whole bunch of types of risk. You don't need to remember each one of these individually, but they will serve as the justification for why we invest the way that we do. So we're going to start with the stuff that you can pretty much get rid of first, and that's unsystematic risk. It's risk that is not characteristic of the system of investing in the market. It's risk that is characteristic of the specific investment itself. So accounting, if they just have bad books, that's not risk because of some S&P performance, that's them having a bad practice. Business risk, just them failing at their business. Country risk, specific location where some certain thing goes down, like if a tariff hits them really hard or a war goes on or something of that nature. Countries come with their own risks as well. Default risk, default risk is something that is, if you're holding on to a bond and that company does not have a very good credit score, then there's a higher chance that they might default on that bond and then you don't get your initial money back. But if you buy a whole bunch of those bonds, if one of them doesn't pay you back, it's not so much of a big deal because we've diversified that into a lot of different loans. Executive, which is basically just saying the people at the top making poor decisions. Financial, which is kind of similar to accounting. And then government and regulatory, which is just like if a regulation comes in or a law changes that stops that company from being able to conduct business. This one actually can be pretty severe, not just for individual stocks, but for concentrated sector funds. Think about energy funds or oil funds or utilities funds or green energy funds, anything of that sort, anything that just has this. If you remember a while ago when Joe Biden was first in office, cannabis funds were just flying. Everybody was thinking it's going to get legalized and it's going to be all over the country, federally legalized everywhere. It's going to be amazing. We're going to make so much money because there's all this tax revenue from California and Colorado. Then they just kind of stopped talking about it at all, and they just kind of forgot about it. And now all of those funds are down about 80% since then. So they just never really followed through with that. And because all of that hype, all of that was built into that, all of that performance was just wiped away. But then if we move over to the other side, these are the things we have to be more actually aware of, because if we invest using our principles, most of this will be taken care of. But these are the things that we have to be very active about. We have to be very aware about, because they can't be diversified away, but you can manage your exposure to them. We can basically diversify away business risk by saying Apple is only 0.1% of my portfolio, and that will make basically no difference in the long-term returns. What you can't do is diversify away market risk, because then if you do, you also get rid of the return that it would have given you. So if you were expecting to make 6 or 7% a year, but you say, all I'm going to have is T-bills, we're probably not going to make it there because we don't have something that can grow at that level. But first and foremost is purchasing power. This comes by a few different names: purchasing power and inflation. So this is the main thing, that even if you want to be very conservative and you don't want to take a whole lot of risk, you want to think about purchasing power. Because when we talk about returns, we talk about average returns, we're talking about returns before inflation. So if you're thinking about getting like 1% or 2% in a fixed annuity, but inflation is 3 or 4 or 5%, the purchasing power of your dollars is actually going down over time. It's not even keeping up with the cost of goods increasing. And that is our number one thing that we can really easily fight against. That's why if you've got like a big savings account, at least put it into like a CD or a short-term treasury fund or something and earn a couple percentage of yield so that we're not losing entirely to purchasing power. The worst thing you could do is put your money in an account where it earns nothing, because then you will give yourself a 100% chance of losing money every single year as compared to what things cost outside. Reinvestment rate is really just if you are if like say a bond matures and you had a nice big 10% coupon on that bond, and now you have to reinvest back in at 7%. That's a little bit of risk that now the interest rates went down and now you don't get to get as much interest. So that's something that is kind of, it's difficult to manage, because you have to be right about how long are these interest rates going to last, how high are they going to go, when are they going to drop. So that's a hard one to manage. Interest rate risk, though, which sounds super similar but is a little bit different. Interest rate risk is sort of the idea that if you're holding on to bonds, if you're holding on to, let's just say government bonds, for example, and they pay you 5% and it's worth $1,000 today, but then the government says, we're going to start offering bonds at 7%. Nobody's going to want to buy your bond for $1,000. they're going to want to buy a bond for a price that makes your 5% equivalent to 7% of $1,000. So it needs to be an equivalent exchange. That's that sort of efficient market that we're talking about. And then you've got your market risk, like I talked about before, which is just simply fluctuations in the economy, stock prices going up and down, not getting away from it. Then you've got exchange rate risk, where when you have investments between different companies in different currencies, you are going to be, you are not going to be able to escape the differences in the value of the currencies. So the investments may perform a certain way, but then the relative currency values may also change in a completely different way. So that's something to be aware of as well. So these are things we can't get rid of, but we can sort of manage our exposure to them. If we want to manage our interest rate risk, for example, maybe we don't want our bonds to be 30-year bonds, because if we're locked in for 30 years at 5%, and now they offer a new big long bond at 7%, that value is going to drop by a lot, because it's this whole 30 years you got to make up for that difference in that interest you're not receiving. If we want to manage our market risk, well, we have to accept pulling back on our stock allocation because we don't want to take as much risk. So it really just is a push and pull of what you're in, and you can't get rid of them, but you can manage them. Versus these, with our principles of how we invest, you hopefully should not have to worry about them too much. So what are we going to do to address these risks? We just talked about a whole big list of risks that are out there and what we're going to do. Well, for the systematic risks, the ones that are part of the system of investing, we're just going to manage our exposure and allocate our position categories based on time. So if we only have a few years before an expense, we're not going to dump it into an S&P 500 fund and expect every year to be positive until we take it out. We're going to use more of a stable asset. If we have a whole lot of time and we're willing to go through with that market risk, then we'll do so. For unsystematic, we're going to break down our allocations into multiple specific assets with different underlying holdings, but we're also going to use really inexpensive, broad index funds that take care of investing in a huge big bucket of the market and using that as our baseline. That's our baseline for our allocations. Then we can add what we like on top of that to sort of mitigate against risks that we find present in the market. So, limiting your exposure to any one type of unsystematic risk. For most of these, because all of these are company specific, just don't put all your eggs in one basket or stock. Don't buy one stock, don't buy two stocks, buy tons of stocks, lots of them, lots of stocks, and this will usually not be much of a problem. Lots of different stocks. Countries, diversify among foreign countries. Like we saw early this year, it was important to have international exposure to some degree. You know, some people like to, for the stock portion of their portfolio, the bullheads, they like to buy this fund called VT, which is just Vanguard's total world stock market fund, and it just covers everything, and then they just don't worry about it. And that's a fine option. Some people like to have a little bit more US because of how we've performed recently, but who's to say whether that's recency bias or not? For default risk, diversify among the bonds and lean towards high quality when it makes sense. Lower quality bonds can pay a lot of really good interest, but especially for the shorter term needs and the things that need to be more stable, lean towards high quality or government bonds. They'll help you out a lot. And then government and regulatory, make sure you're diversified among your sectors. If you have concerns about how concentrated our current market indices are in technology, you may use things like sector funds to sort of build a little bit of moat around that and get more evenly distributed. So depending on what your thoughts about that concentration are, you may have a little bit of diversifying that you're going to want to do. When it comes to managing systematic risk, managing the risk that just kind of comes with playing the game, don't leave your cash in cash for purchasing power. If all you do is get a high yield savings account, that's better than nothing. You can get it into short-term treasury bills, treasurydirect.gov. You can buy them. They're still getting pretty good rates. I haven't checked them in a little bit, but funds like SGOV and BIL and VBIL. There are these funds that will give you super, super short treasury bills and you get a nice little bit of yield while the rates are strong. And then that way, you're not exposing yourself to a ton of risk, but you're at least getting a little bit of return and maybe you're not losing so much to inflation.
Sure. What is that? Week, a month, a year?
Yeah, so the question is, what is short term? When I say short term, I usually mean short term could be, I would say 3 years or less. Ultra short would be 1 year or less. Ultra short is what I like to use for when you want to consider it cash. You basically want to consider like this is something that I'm not taking any risk on. Ultra short is what I'm looking for. And I still want to make sure that if they're going to be corporate bonds, like highly rated, but usually I like treasury bills for this example. So a treasury bill will always be 1 year or less, which is why it's one of our favorite picks for a sort of cash position, because 52 weeks or less, pretty good interest rate, and you can, they're very liquid. You can buy in and out of them very easily.
So tax.
Tax situation on treasuries. So for a corporate bond, you pay your full federal and state taxes. Treasury bond, you pay no state taxes, only federal taxes. And then a municipal bond, you pay no federal taxes and you pay state taxes unless it's your home state's bond, in which case you pay no taxes at all. But the rates are a lot lower. So you got to kind of compare it against your tax rate. It's a little, another conversation we can have a little bit later. On the interest. So on the interest that gets paid out from the fund. Yeah. So for reinvestment rate, when rates are good, lock them in. What does that mean? It's hard to define because everything's relative, obviously. I haven't even been in business during the times when rates were really high. Can you give us some examples from back then?
80 to 82 or so, remember people buying houses with more than 16%. And treasuries, if you bought a treasury bond for 30 years at 5%, now they're selling them at 10, your bond just dropped 50% if you try them sell.
Yeah, so again, 16 to 18% interest rates way back before I was ever even conscious of the idea of an interest rate. So it's kind of difficult to know when rates are good, but if it's a rate that you like and that makes you comfortable and that you would be, sad with a lower rate, maybe it's worth it to buy a longer term bond or get into some higher rate investments like that and lock it in. For interest rate risk, we like to keep what's called duration low. We'll get into what that actually means in the future, but it's essentially just kind of like, what's the length of the bonds in the fund that we're looking at? So if I'm looking at an ETF or a mutual fund, and they've got a whole bunch of bonds in there, some expire in 5 years, some in 3, some are coming up in a year, some are 10. The sort of average, all of that together, combined with how much interest they earn, is going to give us a number that's called duration. And duration is effectively the fund's sensitivity to interest rate changes. So like I talked about, where if you have a $1,000 bond at 5% and then suddenly they're being sold at 7, it's going to drop by a little bit. Duration is like a way to measure how much it's likely to drop. Whatever the duration of a fund is, that will be its pretty much opposite reaction to an interest rate change of 1%. So if the interest rate goes up by 1% and the duration is 5, it's likely the value of the investment will drop by 5%. And that's sort of just a factor of the interest that it earns and the length of the bonds in the portfolio. So with the market risk, allocate with time in mind. Think back to those things that we looked at where the longer the time is, the lower the risk gets. So just make sure that when you're dealing with market risk, you're kind of understanding what your time frame is. And for exchange rate, diversify among those foreign countries. Do include some international investments. Based on the back testing that I did, I found most success at about 15% of my equities being international. That might change, that might not be enough, that might be too much, but that's just kind of what I'm working with right now in portfolios. And so, again, what we use in order to accomplish these things: lateral integration, and vertical integration. Lateral integration being how do we use time and our overall risk tolerance, usually meaning that short term, less risk, intermediate term, a little bit of risk, long term, all of the risk. And then vertical integration, where we get nice, cheap, broad exposure. Maybe we can get a little bit more specific if we like certain sectors, if we like value funds, for example. And then maybe we can take some more gambles, like if we really like nuclear energy or something, we can top it off with a little spice at the top. So again, remembering new portfolio construction theory, our time horizon dictates our level of risk. Day-to-day positive and negative returns statistically average out to a positive expected outcome. Again, that's law of large numbers. That's exactly what we were talking about before. Remember that chart with the Dow Jones where there was a green up and down and green up and down, and all of it was ridiculous, and there were 40% and 30% and 20%, but that long-term average was just under 9, a nice smooth 9. So remember, those day-to-day positive and negative returns will statistically average out to that positive expected outcome. All of the averages we talk about today, if we talk about an average 10% return or an average 12% return, include things like the 2008 financial crisis, include things like the crash during COVID, include things like the dot-com bubble, include things like the Great Depression. All of these things are part of these averages. Go risk off for liquidity. Don't take a whole bunch of risk if you need that cash available today, and go risk on if you're trying to grow, meaning buy stocks, buy things that are expected to grow in value if you need to increase that value. Now, again, here's asset class returns, highs and lows, and their compound average. I think this is really interesting. It's just pretty much yet another way to describe what I've been talking about, where you have for between 1926 and 1922, we have the lowest that the asset class dropped, the highest that it went up to, and then its average yearly return over the years. So we've got small stocks, large stocks, long-term government bonds, intermediate-term government bonds, and treasury bills. So treasury bills are a nice safe haven friend. They've only ever gone down by, in this time period, 0.02%. And I believe this is total return, so I'm assuming this includes interest. They've gone up by 14.7%, but on an average yearly basis, they make us about 3.2%. If inflation's 3 or 4%, we might not be beating it out. We move over to intermediate term government bonds. They give us an average of 4.9% per year. But within this time period, they went down as much as 9.5% and up as much as almost 30%. Moving over to the long-term government bonds, these dropped as much as 26%. That's a pretty big decline for what has been considered a safe haven asset in the past. They've also gone up by as much as 40% and given us a compound average return of about 5.2%. Which is interesting. There's a lot of extra volatility for just a tiny bit more return there. And then we get to our large stocks, where they went up as much as 54%, dropped as much as 43%, but then gave us an average of 10% compound annual returns. Then we get all the way to the small stocks, the most volatile of the bunch, dropping as much as 58%, rising as much as 143%. And giving us a compound average annual return of 11.8. So it's just really showing, again, in order to get all of these numbers from, approximate almost 100 years of stock data, things had to swing back and forth one way or the other in order to get there. Yes.
I just have a question from Zoom. This is a question. When you talk about the government bonds and bills returns, is that for a bond or a bill fund or buying directly from the Treasury Direct?
Yeah, so I believe that these numbers here, most of the things that will be shown on the Morningstar charts are going to be represented by either indexes or index funds for the most part. It's not going to be based on like an individual bond, But when I talk about investing in bonds and bills and stuff like that, I like to use funds just because, for example, I had a client who liked to get treasury bills and then renew them like every 2 weeks. And so every 2 weeks I would call them and go, "You ready to do this again?" And go, "Okay." And then I would buy the bond. And then there was also an ETF that I could put them in that did the exact same thing for me with 100 different bonds in it, and it costs like 0.09%. So I like to just use products like that because they'll do all of that legwork and you won't have to go out and individually buy the bonds all the time. Now, one thing to mention though is that when you actually buy an individual bond, that bond is yours. The fund manager can't sell it away from you. You get to hold on to that. So if you want to hold the bond through to when the lender will pay you back, that could be a possible reason for wanting to do that. However, I personally like to let the bond managers do the work for me. That's like one of the few areas where I really like actively managed funds is when we talk about corporate bonds or intermediate and long-term government bonds. I sort of like to hand that off. But hopefully that clears it up. If there's another question, let me know. Okay. So again, vertical integration, we're talking about systematic risk. That's our non-diversifiable risk. We manage it with proper asset allocation and lateral integration. Unsystematic risk, that's the diversifiable security-specific risk. That's this risk that we want to get away from as much as we can. We manage it by using a broad selection of different securities. And I'll remind again, this is what happens. This is why we want to do diversification. That company risk stays super high and basically blows out market risk. It's more risky than just being in the stock market, period, being that concentrated in one stock. And then the more and more we diversify, the more and more we get rid of that company risk. And then all we have to do is manage our market risk in total. So that's why we like really inexpensive index funds. Now, next week, we'll get into actually putting this into practice and choosing securities, but I'll just kind of like, I don't know, maybe I'll show you the difference on my Y charts, why we like total market index funds. Because if you look at something like, this is a fund from Vanguard. It's a total stock market index fund. And you'll see all your favorite holdings in there. You'll see NVIDIA, Microsoft, and all of that wonderful stuff. But there are a total of 3,524 different individual stocks in here. So we really like being able to stay diversified across that because it really reduces our exposure to individual stocks. And this even gives us exposure to a whole bunch of different types of things. We get exposure to the really big stocks, the smaller stocks, the little micro stocks, all of the different styles. We get to be in basic materials, consumer cyclical, financials, real estate, communication, technology, energy, industrials, consumer defensive, healthcare, utilities. We get to be a part of everything, and we get to feel the entirety of the economy. Now, like I mentioned before, some of these can get really concentrated. You see, technology is 32.5% of a total market US fund. That's a lot of technology. Whatever your thoughts on that may be, I am still pretty confident about technology, but I don't know, 32.5% is a pretty high concentration. Here, I'll show you that other fund that I was talking about earlier that some people like to pick. So if you wanted to just have total world stock fund, this fund has 10,029 individual stocks in it. So you really are not super concerned about individual company risk. And you can see here how that is split out. So you can see you've got about 67% in the Americas, North America and Latin America, 15.8% in Greater Europe, and 17.49% in Greater Asia. So that gives you a nice, decent amount of sort of all over the globe diversification. But that is pretty much our foundational conversation for how we're going to actually start building portfolios. So I just want to end this with an opportunity for some questions to see if there's anything about like those ideas that maybe are confusing, or if anybody wants to touch on anything before we go.
It's interesting because if you do a total market, or let's say the S&P 500, you end up with like 30% in technology. And if everybody says just buy the S&P 500 and forget it, you've got a third of the portfolio, nearly that, in technology. And if you agree with that, that's great. But maybe I have other tech stocks or other funds, or I just think we've done our run. That makes me a little nervous. Then you go from the baseline of the pyramid to the second one, which are more customized index funds, where it isn't somebody buying and selling, but you're picking, let's say, a total stock market index fund, or equally weighted, rather, S&P 500, or all dividend stocks of the S&P. So that second level has a slightly higher expense ratio, but it's more customized, low-cost index funds. And then the third one is we're trusting somebody to manage it all. So be careful with just following the index, because in 2008, right, it dropped temporarily 65%. Now, if you had an equally weighted S&P 500 fund, it wouldn't have been down nearly as much. But then again, it won't be up as much. So that second level is more customized for a little bit higher expense ratio. Third level is total managed. Ego's involved in that part.
All right.
So I have a question. When you're looking at total stock indexes like that, certain stocks may not be very popular and may not move very much at all within
Sure.
that index. Do you guys consider non-movers as being low risk, high risk, or, because it seems to me like if they are just kind of staying where they're at and there's not a lot of movement in the stock, whereas other stocks may be pushing the S&P up and down in value. How do you guys manage risk from that perspective? Because it seems to me like there's probably a lot of stocks out there that are just maybe holding the S&P in one position because of their lack of movement. How does that play out from a risk perspective?
So we're talking about a stock that just kind of like trades sideways, or is that kind of like what we're?
There are stocks that move, and then there are stocks that don't move, and they may not have as many investors in them, but they might be part of the overall market. So how, if I invest in the whole, like in the whole stock market, even the S&P, there's going to be certain stocks that just aren't moving, right?
Correct.
And I don't know how to perceive those from a risk perspective. To me, it seems like they're just operating at market risk, whether they're going sideways, month in and month out, you're just accepting that. But what I worry about is if I'm in a bubble where, I'm doing all of this, it seems to me like there also could be the inverse risk too of something happening that will cause those to start moving, maybe upward, maybe downward, maybe, economic cycles, something else. So that's why if I see stocks moving, I can correlate things to why they're moving, at least economic potential. I can start to understand the risk, but without movement or without significant movement, how do I understand the risk of something like that?
Yeah, so just as kind of like an in-between for this conversation, when we're talking about total stock market indices, pretty much every single time they're going to be constructed in a way that's called market cap weighted. So what that means is the companies that have the largest market capitalization, which is their share price times their outstanding shares, that highest value is going to be what's invested in the most. Like that's going to be the biggest position. So for example, in something like a VTI, you're gonna have NVIDIA, Microsoft, Apple. I mean, there's a reason that these are called the Mag 7, because they are the top stocks that have been driving the performance for a long time. So when it comes to like the risk profile of those stocks that may not really be the movers, essentially they just kind of get leapfrogged over and replaced by somebody else. So while, yeah, of course, there is the risk that they could move, you know, the further and further we start going down this risk, I'm not even to 100 and we're below 1/4% for many of these. And we could just keep on going and keep on going till we get to under 1/10% in each of these companies. So, you know, you got things like Workday, Airbnb, Ross Stores, Carvana, all of these things that just have such little impact on the actual driving of the price. And if there is something that's going to drive their price significantly, if it's positive, then it's probably going to start ranking higher in the index and then start getting a bigger position. And then it's sort of like a self-fulfilling prophecy. But if they're going to start really tanking, their impact will be so slight on the overall portfolio that it's just really, I think, not necessarily something that you want to use a whole lot of time in order to sort of, you know, check on that risk. I want to see if.
The cool thing is that second layer, if you go to, is it ETF Prime? What's that thing we listen to, the podcast?
Yeah, ETF Prime.
Okay, ETF Prime, it's really exciting, and they'll interview fund managers or ETFs that are created. And there are some that will take the stocks that are underperforming out of theirs and do a 200 S&P 500 fund. So they'll have rules that'll say, if they do this or they do that, then we'll take the top 200 and do an index fund that doesn't include the non-performers. Others might include an index fund that includes all the underperformers, hoping that they will do that. But these new exchange traded mutual funds, they have all these different ways of constructing it. Some are managed, some are just created, and there's one for you. I don't know which one that would be, but if you listen to ETF Prime and go through all their recordings, there'll be a fund that says, wow, this they understand me. Because if you do total market, you've got all these different smaller funds, stocks that don't do you any good. Although we did see in April that the S&P dropped to some extent, and then the total market actually dropped a little more because it had small caps in it and other things, where the S&P 500, I don't think, has many in small caps. So that's the exciting thing, is you're absolutely right. You would be overlooking that if you just do that bottom tier. That's why the next tier is there in custom ETFs that you would like. And they're coming out every day. There's more ETFs than there are stocks. So there, you know, everybody and their sister are doing it, but there may be something that meets your perfect needs.
Yeah, and you can actually see, I'm just kind of briefly showing a chart of both the S&P 500 and that total market index fund. And you can kind of see some of the different moments where maybe here early on, there were some drops that were stronger from the S&P 500, where the smaller companies held them up. But then obviously, recently, we've had a lot of outperformance from those top companies. And so you start to see a gap between where the S&P starts to take off and go ahead of its total market counterpart. So with that, are there any other questions? Yes.
Sorry, going back to that slide about the risks, I think it was just systemic. What was the two categories? The unsystematic.
These guys.
Systematic.
Systematic and unsystematic.
So I was just wondering if things like precious metals or cryptocurrency would be considered to help alleviate, especially maybe the systematic risk, or not, or if they're part of any, you know, strategy or portfolio.
Yeah, so I have always found it really difficult to work some alternatives like that and commodities into portfolios, because they're so, at least from experience, you might be able to speak on this a little bit more than me, but so much performance is so very reactionary. And I don't know if that makes them actually a better hedging tool, because when things are happening in the market, the reaction is to purchase things like, you know, right, exactly.
If you compare Bitcoin and gold, you know, to the dollar,
Absolutely.
it would definitely help their value.
Absolutely.
And maybe other.
So that's something that's where a conversation starts to get really hard, because with Bitcoin, I struggle to determine where its total return came from. Like, where did the price increase come from? Like, what was the Maybe, but
They're constantly printing more dollars and not constantly printing more Bitcoin, just like gold, so.
That's true.
It's worth more relative to this devaluing, you know.
I think that's possibly true, but then, why not Ethereum, why not Solana, why not Cardano, why not anything else? So there's like a lot of other options, like, right, for sure. And for me, it's just like, I want to see more utility when I start looking at something like that. At least for gold, I know that I can name like a bunch of things that it's useful for, even if we're just thinking jewelry, technology, whatever. And I know that Bitcoin has a use case. It struggles to get really adopted in terms of like a real world sort of scenario. Yeah.
And I'm talking about as just an investment, just like the gold, it's just sitting there as a hedge.
Long
Sure.
term, I bought gold at $900 an ounce, and it's worth 3,000, I would say that's a good investment. I bought it in 1979. It's been a terrible investment in that sense.
But you bought it for 900, just 10 years ago as well.
Right, but I mean, if it feels good, it's like having dehydrated food and extra water and things like that. For an emergency, get it because it feels good, but hold it long term. In the short term, could be disastrous or fantastic. It's just
Yeah.
popularity game, and popularity, there's no earnings on gold, and then where do you store it? But you can buy ETFs out of gold.
Exactly, ETFs on Bitcoin and stuff
It's
too.
no bad thing.
Yeah.
Look at something else that's down rather than something that's up, so silver, platinum, whatever else they.
Yeah, so maybe if you have like say you are at a place where you're like, I'm concerned about how far stretched we are, then you might consider putting an allocation like that in there. But I struggle to ever make commodities and alternatives like that part of a long-term investment plan rather than like just a tactile move, because the returns they just don't stack up over time for the most part. So that's just kind of where that is. Anything else? All right. Well, thank you everybody for coming. I appreciate it a lot. That was good. We'll see.